Earning $500 monthly in passive income is the first step to real financial freedom. Most people fail this goal because they chase dangerous high yields instead of consistent growth. If you want a portfolio that pays your bills, you must understand the math for $6,000 a year. To generate the specific monthly income safely, you generally need around 150 grand. This math assumes you target a realistic and safe dividend yield of roughly 4% per year. You could try to do this with less money by chasing 10% yields, but that is far too risky. The foundation of my strategy relies on dividend aristocrats that have raised payouts for decades. We start building this portfolio by putting most capital into a high-quality dividend growth ETF. The Schwab U.S. Dividend Equity ETF, known as SCHD, is the gold standard for this foundational role. This fund screens for companies with strong cash flows and sustainable ratios, not just high yield. Investing in this fund provides instant diversification across 100 companies in one trade. Historically, this ETF offers a yield around 3% with significant capital appreciation. The second pillar of this monthly strategy involves accessing the real estate sector for income. Real estate investment trusts are required to pay 90% of taxable income to investors. Realty Income, known as a monthly dividend company, is a staple choice for reliable monthly pay. This company owns thousands of commercial properties and collects rent from very reliable tenants. However, you must be aware that real estate stocks are highly sensitive to interest rate changes. When interest rates stay higher for longer, borrowing costs for these companies increase rapidly. Despite this specific risk, Realty Income has delivered positive returns through economic cycles. To balance the slower growth of real estate, the third component focuses on pure dividend growth. We look for companies with lower starting yields that grow that payout by double digits annually. Companies like Visa and MasterCard are examples of businesses that dominate markets and raise pay. Although their current yield looks low today, the compounding means your yield on cost skyrockets. This growth component protects purchasing power, ensuring your 500 buys the same things. Now that we have stability and growth, we can add a tactical position to boost our current yield. This involves covered call ETFs like JEPI, which generates income by selling options on the index. This fund has frequently delivered yields ranging from 7 to 10% to boost your income. The major downside is that covered call strategies cap your upside potential during bull markets. You are trading away the possibility of explosive capital gains in exchange for consistent income. I recommend limiting these high-yield funds to no more than 20% of your total account. With these four components, you create a machine that generates cash regardless of market swings. The most critical step in this process is setting up an automatic plan that buys shares on payday. You cannot time the market perfectly, so dollar cost averaging is the only proven way to succeed. When you first start, your dividend income will be small, which can feel very discouraging to you. This is a valley of disappointment where most new investors quit because results happen slowly. You must enable the dividend reinvestment plan to use dividends to buy more fractional shares now. This creates a snowball effect where your dividends start earning their own dividends over time. Let's look at the math. Investing $1,000 a month helps you hit six figures quickly. Reaching the first $100,000 is the hardest part of the entire wealth building journey. Charlie Munger famously said that you must do whatever it takes to get that first 100 grand. Once you hit $100,000, compound interest does more lifting than contributions. Remember that dividends are not free money. The stock price drops by the dividend on the X date. However, profitable companies recover that price drop over time as they generate earnings for you. For a tax-efficient strategy, you should prioritize holding these assets inside a Roth IRA account. In a standard brokerage account, you'll be taxed on these dividends every year, creating a drag. Another massive risk to monitor is the payout ratio, measuring earnings paid out to shareholders. If a company pays out more than 100% of its earnings, that dividend is very unsafe. Always look for a payout ratio below 60% for general stocks and 90% for REITs. Sector diversification is mandatory. Do not put all your money into energy stocks for high yield. A well-balanced $500 portfolio needs tech, healthcare, consumer staples, and finance. One often overlooked strategy is to focus on companies with wide moats that are very hard to copy. Warren Buffett seeks wide moat companies because they maintain pricing power during high inflation. If you start with zero today, your goal should be to reach your first $10 monthly income. Once you see that first passive income deposit hit your account, a major psychological shift hits. You speed this up by cutting expenses and diverting extra cash directly into your dividend plays. Every dollar you waste on things you do not need is a dollar that could be working for you daily. When you view spending through the lens of lost future income, it becomes easier to save capital. Remember that a $500 monthly income stream is equal to a $6,000 raise. The difference is you do not have to work extra hours or beg your boss for this financial raise. As your portfolio grows, you will eventually reach the point where dividends cover major expenses. For most people, covering a grocery bill or car payment with dividends is a massive breakthrough. You must remain disciplined and avoid selling shares when the market drops to avoid capital loss. In fact, market corrections are the best time to buy dividend stocks because yields become higher. If you stick to quality companies with long histories, a recession is a discount on future income. Building this income stream takes time, patience, and refusal to speculate on improving companies. Start small, stay consistent with your contributions, and let the compounding math work for you. I want you to comment below with your current monthly dividend goal and which stock you are buying. If you found value in this breakdown, please subscribe to the channel so you never miss an update. Building wealth is a marathon, not a sprint, so ensure you have the right partners with you now. Click the video on the screen to learn about the 3 dividend stocks I am buying heavily today.